All right, today we're going to talk about one of the most powerful and, let's be honest, most stress-free strategies for investing in crypto. If you've ever felt that pit in your stomach watching those crazy price swings, then this explainer is absolutely for you. So, let's just dive right in with a question. I want you to really think about this for a second. When you're investing in something as wild and volatile as crypto, who or what is your single biggest enemy? Is it, I don't know, hackers? Scammers? A sudden market crash? The answer, and this might sting a little, is the person staring back at you in the mirror. It's you. Or more specifically, it's your emotions. It's that feeling of pure panic when prices drop, and that intense fear of missing out, FOMO, when they just skyrocket. Those two feelings, fear and greed, are without a doubt the biggest hurdles for pretty much every single investor. But don't you worry, we've got a plan. In this explainer, we're going to walk you through exactly how to deal with that enemy. We'll start with the problem, then introduce the automatic solution, show you how the math works, give you a simple 5-step setup, cover the big mistakes to avoid, and finally, get you into the right mindset for long-term success. Okay, so let's officially kick this off. Section 1, your worst investing enemy. The whole key here is to reframe how you think about crypto investing. You got to stop seeing it as just a financial challenge. Really, it's a psychological one. Winning is way less about picking the perfect coin at the perfect time and so much more about mastering your own impulses. And that brings us perfectly to Section 2, the automatic solution. So what if, just what if, you could take those gut-wrenching emotional decisions completely out of the picture? Well, you can. It's a beautifully simple, totally disciplined approach called dollar cost averaging, or as everyone calls it, DCA. So what exactly is it? It's simple. You invest a fixed amount of money, let's say $50, on a regular schedule, like every single Monday. And here's the most important part. You do it no matter what the price is. Is the price way up? You buy. Is the price crashing? You still buy. You just stick to the plan. And this is precisely why it's so powerful. You've probably heard the saying, time in the market beats timing the market, and DCA basically puts that on autopilot. But the real magic is in the math. When the price is low, your $50 automatically buys you more crypto. When the price is high, it buys you less. It just smooths everything out, and crucially, it's a system designed to save you from yourself. All right, Section 3 is where the rubber meets the road. We're going to prove it to you. Let's look at how the math actually works with a really simple comparison. DCA versus just throwing all your money in at once, which is called a lump sum investment. Okay, check this out. Imagine you have $1,200 to invest. With a lump sum, you put it all in during month 1 when Bitcoin is at $60,000. You end up with 0.02 Bitcoin. Simple, right? But with DCA, you only invest $300 each month. Now, look at month 3. The price drops to $30,000. That same $300 now buys you twice as much Bitcoin as it did in month 1. By the end, you've invested the exact same $1,200, but you've managed to accumulate way more, a total of 0.0285 Bitcoin. And this chart just says it all, doesn't it? I mean, look at that. That taller bar for DCA isn't some tiny little difference. You use the exact same amount of money, but because the strategy took advantage of that price dip without you having to lift a finger or panic, you ended up with a lot more of the asset. It's pretty incredible. How much more, you ask? A whopping 42% more Bitcoin for the exact same dollar investment. Now look, this specific scenario won't happen every single time. If the price only ever goes straight up, a lump sum would win. But in a market that goes up and down like crypto does, DCA protects you and actually turns that volatility into your advantage.
Okay, so you're probably thinking, this sounds awesome, but how do I actually do it? And that brings us right to Section 4, your 5-step setup. Think of this as your practical set-it-and-forget-it game plan.
Step 1, and this is so important, decide your amount. And please, only invest what you can truly afford to lose. Step 2, pick a schedule that lines up with when you get paid. Weekly, bi-weekly, whatever works. Step 3, choose quality assets. If you're just starting, sticking with the big established players like Bitcoin and Ethereum is your safest bet. Step 4, and this is the key to the whole thing, automate it. Every major exchange has a recurring buy feature. Use it. And finally, step 5, walk away. Seriously, stop checking the price every 5 minutes. Let the system do its job. Now, as simple and amazing as this strategy is, there are definitely ways to mess it up. So in Section 5, let's talk about the common mistakes you absolutely need to avoid to protect your plan. Okay, if you only remember one thing from this whole explainer, make it this. Do not, under any circumstances, stop your DCA during a bear market when prices are falling. I know it feels terrifying, but that is the most critical time for this strategy. That's when your dollars are working their absolute hardest, buying up so much more crypto for so much less. The other mistakes are basically letting your emotions sneak back in, changing your amounts on a whim, trying this with some unproven new coin, or thinking it's a get-rich-quick scheme. DCA is a marathon, not a sprint. You've got to be in it for the long haul.
And that leads us perfectly into our final section, number 6, the accumulation mindset. Because this isn't just a strategy, it's a fundamental shift in how you look at investing, period. And this really just sums it all up. A lump sum can be psychologically brutal. Can you imagine investing your life savings and then watching it drop 40% the very next week? Most people would panic and sell, but DCA, it just fits how most of us earn our money, a little bit at a time. It actually makes downturns feel like a discount, not a total disaster. For beginners, it's just a safer, more sustainable way to build wealth.
So here's the big takeaway. You need to retrain your brain. You have to stop obsessing over the daily price. Instead, start focusing on your total accumulation. How much Bitcoin do you own? How much Ethereum? Every single recurring purchase is just another brick you're adding to your financial foundation.
Ultimately, it just comes down to this one simple question. Are you ready to stop gambling, trying to time the market perfectly, and instead start consistently building your position for the long term?
And hey, once you start building that foundation, you absolutely need to know how to protect it. That's why in our very next explainer, we're diving deep into crypto wallets. We'll break down hot wallets, cold wallets, and the super critical concept of not your keys, not your coins, so you can learn how to truly own what you've worked so hard to build. Make sure you check it out. We'll see you then.